Hmm? A very good afternoon and early good evening to all our viewers and esteemed panelists. Thank you so much for joining us. So we have viewers who have joined us across sections of our practice, which includes financial services, industry practice, and tech-enabled and digital practice. So thanks for taking out time out for viewers, and let's get on with the agenda as scheduled for the evening. To begin with, as we know, Indusion primarily focuses on financial services across middle and senior level, along with industry and ITES practice. And in fact, if you go by today's topic, which basically touches upon more about the whole uh, leadership, which is exponential leadership, which is there in form of the panelists today. And we're going to talk broadly about unprecedented crisis to unprecedented growth. In fact, in our whole tenure of Indusion, we have seen lots of crises in last 2 decades, which includes our starting from .com to what we saw in 2008 in the Lehman crisis, and obviously this one is a very distinct, and that is what we all are here to ideate today. So, along with welcoming our panelists again, let me quickly introduce all our panelists today, starting from Mr. Ashok Wadhwa. As we all know, Ashok is regarded as an incisive, innocent banker and a consumer deal maker who has handled a large gamut of transactions across sectors and geographies. Lauded for his excellence in the field of finance, he is also the recipient of several awards, including Padam Shri Award uh, for outstanding contribution to the field of financial management. He was also earlier managing partner at Ratan Anderson in Mumbai. Ashok has impeccable academic credentials and he's a chartered accountant and a company secretary and a law graduate by qualification. Moving on to our next panelist, Mr. KVS Manian, who is a whole-time director and member of the group management of Kotak Mahindra Bank. Manian currently whole-time director, corporate institutional investment, banking and wealth management at Kotak Mahindra Bank. He has about 2.5 decades of association with Kotak Bank, Kotak Group. He has been instrumental in setting up and sets up many business divisions and success stories. He is currently responsible for building a high quality corporate franchise and offers integrated corporate and investment banking solutions. Prior to this, he was the president of consumer banking, steering the bank from a single branch to 600 branches and more than 1,000 ATMs across the country in the last 10 years. He's philanthropic by heart and also a very great vocalist and extremely fond of old Hindi songs. And he's at his best to sing those songs. Moving on to our third panelist, Mr. Dhanpal Jhaveri, who is the vice chairman at Everstone Capital and the CEO of Eversource Capital. Dhanpal joined Everstone in 2008. He has over 24 years of total experience in the financial services industry, and also quite a lot of that is into the corporates. As a vice chairman, Everstone Group in Mumbai, he looks at the India business and also responsible for the green infrastructure project through Eversource Capital. He is passionate about the environment. He mentors young business leaders and entrepreneurs. He is also on the board of Avasara Leadership Academy that aims to cultivate India's next generation of women leaders. Dhanpal is also a Bachelor of Commerce from University of Mumbai and Masters in Business Administration from Babson College. And now we move on to our moderator and the fourth and the panelist is Nitin Jain, who is the CEO of Edelweiss Global Investment Advisors, which includes their asset, wealth, and advisory business. In fact, a total asset of around 1,60,000 crores plus. Nitin has a 1.5 decades of rich experience in financial services industry and heads their, as I said, global wealth management, capital markets, and asset construction business, which he has witnessed significant growth. The business encompasses the entire range of asset management services, including alternative funds, mutual funds, asset reconstruction, as well as wealth management. He has played a key role in guiding Edelweiss transformation from a boutique investment bank into the India's leading diversified financial services company. Nitin is also actively involved within Edelgive Foundation, the strategic philanthropic arm of Edelweiss Group, and is also part of the investment committee. He has a BTech and an IIM Calcutta by qualification. Now, that's what on the broad introduction, and also a request to all the viewers that you have a Q&A section which is active. In the towards the end segment, we are going to pick up selected questions which will be pointed to our panelists. So feel free, write to us. In the last segment, we are going to pick up those questions for you, which will be pointed to the panelists. With that note, Nitin, let me hand over the button to you. Over to you.
Thank you, Vijay, and thank you, the Indusion team, for putting this together. First of all, I would like to welcome my co-panelists and extend a heartfelt thanks to the entire audience to make time and attend this. And I think between the perspective from all the stalwarts on this panel, in the next, our attempt would be to dissect the current situation and understand how do we navigate this crisis, an unprecedented crisis, nevertheless, and also capitalize on the opportunities that may emerge from this crisis. It seems very unreal that at this time we are talking about opportunities, and I would put a few points around that maybe a little later. But indeed, this is unprecedented by any stretch of imagination. None of us would have thought some time back that we would be doing a webinar of this kind, where we would be sitting in our houses and connecting with more than 1,000 people across the country. But it's unreal. But all of us, including the panelists, including the audience, I don't think any of us in our careers, in our lifetime, we would have seen anything of this nature, which is not only financial in nature, which is also a big humanitarian crisis. And we tried to compare this crisis with a lot of previous ones, and hardly we could find a comparable, except for maybe SARS. But SARS, in that sense, was quite limited to a particular geography. And if you go back in those times, the world was not so interconnected, and hence probably the impact was much lesser. If you think about it, the only parallel that maybe we can compare this with is the Spanish flu, which happened in 1918. And over the last couple of months, a lot of data has been circulated around its impact. It probably was the worst recorded pandemic to have occurred in the history of mankind. And it infected more than 500 million people, which was effectively 1/3 of the human population at that time. And it's estimated to have killed anywhere between 30 to 50 million people of that generation. But you know what actually stood out for me is this chart, which I'm just going to put up for the audience to see, and that will put our topic for today with some context. And I hope I'm able to get that right. Sharing. Yeah. I hope the chart is visible. This is the performance of Dow Jones during the Spanish flu outbreak. And if you see, this is how the market behaved after the flu ends. The flu ends in around November 2018, and the market goes up around 45, and market actually kept on going up. And it was quite surreal for me, because to believe that in the middle of such a big crisis where 1/3 of the population is infected with the flu and 30 to 50 million people expire, you're seeing markets and economy bouncing back like this, which just talks about the resilience of the humanity as a race. So I think with that, I would like to actually go back to our panelists and maybe ask them, and maybe I can start with Ashok, you. Uh, how big do you think is the impact of this crisis? And as I said, at least I can't think of any previous crisis which I can compare this with. What do you think is the impact of this crisis on Indian economy, on I think BFSI sector in general, and how are you guys thinking of positioning around it and reacting to this?
So,
Ashok,
thank you, Nitin. These are truly exceptional times. As you rightly pointed out, who could have anticipated in the first week of March? You know, I remember we were all in a fantastic conference hall, iconic location, hearing Stephen Schwarzman talk about his famous book, What It Takes. And that was only on 5th of March.
Yeah.
And on that day, who could have believed that 2.5 months from that day, we will be cocooned? Actually, who could have thought that 3 weeks from that day, we would be cocooned in our houses, learning to deal with a completely new economic, technological, and business environment. But you know, the nicest thing about human race, and that's been demonstrated generation after generation, is the first reaction is a bit of despondency. The next reaction is a bit of anger. Despondency for why did it have to happen? Anger for how can I beat it? And the eventual reaction is one of embracing. Embracing the changed scenario because you know you can't do anything to fight it. Embracing the new scenario because you know if you don't embrace it, then you will be the last in the queue. Embracing technology the way we have all embraced it. You know, we are having a webinar on Zoom right now. Before this, I had never used Zoom in my life. And now I'm reasonably proficient. I even share my screen with people. Learned all this. And you know, these are great advancements if you look at it in one way. So my own view is that we have to learn to live with the situation. The one thing nobody can predict now is when we'll be free of the situation and whether ever will we be free of this situation. I know there is an anticipation of a vaccine coming in, and we think that this vaccine will be a magic which will protect us and life will go back to being normal. The one thing I can say for sure, Nitin, is that life is not going to go back to before March 4th or March 22nd, whenever the first lockdown happened. Certainly not in my professional lifetime. This pandemic is going to leave a lasting impression on all of us. Question is, what is it going to do to our economy? What is it going to do our business? What is it going to do the BFSI sector? Here is what I can say, that in the short term, there is going to be economic destruction. We are already witnessing it. The budget had projected a 10% nominal growth in GDP. If you take inflation at around 4%, the budget had projected a 6% growth in real GDP. And this was what? This was only on February the 1st. And here we are on May the 15th, very sure about one thing, that there is unlikely to be any growth in the GDP in the current year. The debate now has moved away from whether the 6 is 3 or 2 or 1. The debate now is, will it be 0? And if it is not 0, how bad will it be in terms of contraction? So I think in the short term, we all have to brace for an economic environment which will contract for sure. Having said that, it is my belief that the status quo will not remain exactly in this situation. I think science has made enough progress and human beings have shown enough resistance that over a period of time, whether that period is 12 months, 24 months, 36 months, one doesn't know, that we will emerge and hopefully we will emerge stronger out of this. So as far as economy is concerned, we have to learn to brace with a difficult scenario. horrible for over-leveraged companies, horrible for companies that believed that P&L is more important than balance sheet, wonderful for companies that have restored sanctity and sanity in their balance sheet. I personally believe that this particular pipe that we are navigating at this point of time has a silver lining at the end of the tunnel. The question is, when will the end of the tunnel arrive? The other question, how many people will be able to survive that whole journey through the tunnel to be able to emerge at the other end and prove to be victors then? Because I do genuinely believe, Nitin, that at the end of the tunnel, there is a larger opportunity, an opportunity which will encourage inorganic growth, an opportunity which will mean that some very good assets are realistically priced, an opportunity which will mean that those who remain strong and those who have strong balance sheets through this process will emerge as winners, not only in terms of survival, but in terms of growth and acquiring and making these inorganic opportunities reality. What does it mean for the BFSI industry? Again, you can divide the industry into two parts, agency business and the balance sheet business. I personally believe for agency businesses, this is a good time. There will be heightened M&A activity because, as I said, there will be some strong companies and there will be a lot of good but weak companies. And the strong companies will go acquire these weak companies to make up for the lost time. So some very strong companies will emerge, even stronger companies will emerge at the end of the pipe. So a lot of M&A activity is likely to happen. A huge amount of business will happen in the distressed space because over-leveraged balance sheets will have to do something. And we already know a few in the marketplace. They're having to fend for themselves. Promoters are willing to sell their ownership at this point of time, and asset values are real price now. So the inflation in the asset pricing has currently gone off. So I'd like to believe, the whole space of stressed asset, whether it is funding, whether it is buying, whether it is an ARC business, whether it is restructuring business, all of this will have a phenomenal opportunity. Wealth business. I personally believe this important challenge is going to relocate and change the focus of the wealth business. It's been driven by distribution so far. It's going to be now driven by high quality advisory businesses. Those who can win client trust, those who make client as the center of their business are going to be winners in this race. We can continue talking about how many more changes will happen. I think the bigger issue is on the lending business. And there, honestly, with KV there, Manian there, I would rather leave it to him to respond to what does it do to the lending business today and what's the opportunity for the lending business tomorrow. But I remain optimistic on one issue, that those who have built their business with care, those who have built their businesses with some element of conservatism, those who have believed in the two, historical important perspectives of strong balance sheets and strong cash flows, are going to have a phenomenal opportunity to consolidate, to make inorganic grow and grow. So at the end of it, the consumer will still consume, although the consumption may contract for a period of time. The investors will invest, although many will lose appetite in this period. But as we come to the end of the tunnel, I think we will start feeling more normal. And I remain confident that the medium to long-term opportunity remains significant, particularly for those who survive the journey through this tunnel.
Fantastic. Thank you, Ashok. Maybe Manian, you can take from where Ashok was talking about the lending businesses, and who better to talk about that than you. So maybe please, if you can go ahead.
Yeah. Yeah, I agree with most of the things Ashok said. They were completely bang on. I think I agree with most of what he said. Clearly, I think this is a time, two things I am quite clear, that the next 3, 6 months or 12 months, I don't know as of now what the time period of this will be, but whether it is 6 months or 12 months or it bounces back in 3 months, my belief is that it is 6 to 12 months, not shorter. Will definitely test the resilience of the financial sector for sure, and all parts of financial sector it will test. Of course, lending business I'll come to, which has its own challenges, but even the other franchise businesses will struggle for revenues in this time, whether it is wealth, investment banking, all of them. I think for the next 3 to 6 months, I think everybody is going to struggle on revenues. Having said that, I think as we come out of this, I think newer opportunities will come in that. On the financial and on the lending part of it specifically, I think the strong balance sheet point of view that Ashok mentioned is something that we have always believed in, and I very, very firmly believe that balance sheet is very critical. A clean balance sheet, ability to take shocks is very, very critical. And it goes without saying that the lending books of most banks and NBFCs, all the lending institutions, will take some serious hit in this period of time. Very early to say as to what the kind of hits that will happen in this, because still there are too many variables at play to come to a conclusion on what kind of hits will happen. Because to what extent the government gets involved, is the recovery fast enough? Is it 3 months, 6 months, 9 months, 1 year? Is there going to be like I said, support to MSME is there? Are there going to be job losses in the bigger companies? As things stand now, bigger companies have to fend for themselves, right? Industries, as it is now. So are they going to do stuff which will cause job losses and things like that? So I think there are too many variables at play. So to come to a definitive number is difficult, or magnitude is difficult. But clearly, I think losses on the lending book is going to be serious on the on all the lending institutions. And if that happens, one of the things that will happen is, I think, of course, many of them will have to will need capital. And therefore, to make the balance sheet stronger, they'll need capital. And the second thing, of course, is that during this period, how they manage their balance sheet in terms of conservatism and conserve capital is very critical. So I think their conduct in the next 3 to 6 months will be critical. I also believe that unlike in the past, the financial sector, in the last 10 years has seen a significant opening up, right? If you see the almost the entire NBFC sector, other than a few who survived the last NBFC crisis, were born after the last GFC, right? The entire sector has been built up over the last decade or so. There have been several small finance banks. There have been several payment banks. And therefore, the financial sector, the complexion of the financial sector today is significantly different from what we have seen in the past crisis. And I think each one of them will have their own kind of challenges. So, even financial sector is not one monolith, and the problems are not going to look similar. They are going to look very, very dissimilar across within the financial sector. So I think these are going to be really testing times. And I feel that really resilient players, the stronger balance sheet players, people who have high quality of human capital, all these will be very critical to navigate the next 6 to 12 months. And I do believe that at the end of that period, there'll be significant consolidation. And the consolidation, when I say, it is not necessarily inorganic. The consolidation can happen by M&A. It can also happen by mortality, right? So because mortality can lead to consolidation of market share. I think both will happen in the sector. And that's where the opportunities for the stronger players will come at the end of this period. Last time we went through this crisis, I have gone through several of them now in my career. So the last NBFC crisis, a handful of them survived, right? So I think the sector got cleaned up, stronger players survived, and some of them have continued to grow from there. Then again, there has been a built up. Again, there'll be a consolidation, and a few will survive, and again, it will move on. So I think that's part of the game, and that's going to happen across, across various aspects of financial sector.
Excellent. Thank you. And then, Paul, it's only fair for you to have the last word as an investor.
Yeah, so maybe I'll take a slightly different stance and maybe step back and look at it from a global perspective, and then look at what the India relative situation is. I think globally, and if you just look at the last crisis, the big crisis which took place was the global financial crisis. And from 2008 onwards, as the world economy started printing money, we've actually seen massive expansion of capital and wealth on a global basis. And that is pretty much not just restricted to the US, but we've seen most developed markets essentially print a lot of money and generate a lot of wealth. If you look at what China also did on the back of very low cost of capital, they've actually printed again money and they've expanded the economy significantly, using that opportunity to basically go and build markets and build their own local home economies. As a result of which, even before we got into this crisis, the world was already going through almost 10 years of an expansion. And it was almost getting to a point where people were saying that, boss, what's next? Right? They were waiting for kind of the trend to shift and basically move into a slightly more bearish phase. I think what the COVID shock has done, and that shock is not just a demand shock, but it's created both a demand and a supply shock, especially with the lockdowns. So we've suddenly, as a global economy, just screeched to a halt. And as a result of that, globally, I think most developed markets will be in recessionary phase, at least for the next 12 to 24, maybe even 36 months, before they can actually come back and crawl out of and be, I don't think they'll recover that ever, that lost GDP, but basically they will have to come back to that, I would say the stable state. It'll take them anywhere from 12 to 36 months. At the same time, there's expansion of money basically caused interest rates globally to collapse. And with this COVID, if you've seen the extra money which has now got printed, there's a huge amount of extra cash which is now there in the system. So what was $18 trillion of zero or negative return capital now in last count was something like $30+ trillion. It all needs a home at some point in time. Today in the near term, absolutely agree with both Ashok and Manian that there is a risk off happening across the world. People want to move to safety and people basically are focusing on capital preservation over returns. But very quickly, there's going to be a shift, right? In the next 6, 9 months, 12 months, whatever period you say, anywhere in the short to medium term, you will start seeing a shift where people have to start thinking about basically how do they generate returns for all these pension funds to support the contributors, because these economies are not growing younger. In fact, all the youth is all lying in the emerging markets, especially Asia, whereas all these developed markets are really much older and are dependent on income, and which basically, because of a zero return environment, will have to start seeking returns in other markets. The other statistics, if I can give you, that emerging markets 30 years ago constituted only 20% of global economy. Today, they contribute 60% of the global economy. Okay. And just in the last 10 years, if you look at India's own track record of increasing FDI flows, right? We are one of the largest markets in which FDI flows besides all the NRI remittances that we get. So I think there are two parts. One is obviously that getting into COVID, we were already facing headwinds. There was the bank balance sheet problem. There was the leverage corporates problem. ILFS came, that created the NBFC problem. And because NBFCs were all lending to the real estate industry, that created a real estate industry problem. So we are dealing with 4 very large balance sheets, which are all in some form or measure already struggling. And now with COVID, we've pretty much tipped, and everyone agrees that it's going to be a recession this year. It's not going to be a contraction of GDP. It's definitely not going to be a growth in the GDP this year. So, so if I look at it from an investor's perspective, this is possibly the worst time and the best time. The worst time because all as investors, basically we are invested and we've suddenly seen anywhere from a 15 to 50% erosion of value in the businesses that we own. But it's also the best time because if you look at historically, and again, just pointing back to the GFC, in 2008, if you look at the vintage of all capital invested, and on a global basis, I'm talking about, not specifically any market, the total return on capital in 2008 of funds invested in 2008 were basically 8%. The total return on invested capital of funds invested in the calendar year 2009 was 28%. Now, obviously, that was a V-shaped recovery because it was purely financial led, which led to demand destruction, and therefore, for a period of time, till the economic stimuli came in, the economy had kind of slowed down dramatically. This is going to be quite different. It's not a V-shaped recovery as we all are talking about. It's going to take longer. And therefore, the first and most important thing for everyone to do is basically shore up the balance sheet. And if you talk to anyone who's been talking in various webinars across the last 30 to 50 days, they've only been talking about 2 things there. Strengthen your balance sheet, get more cash, get liquidity. And the second thing on a P&L is reduce your costs. Because the timing of getting out of this trough is something which is yet uncertain. So good companies will first basically make sure that their own house is in order and they don't have to depend on someone else, at least for the next, ideally 18 months, but at least for the next 12 months. And that's what you're going to see. I think this round will be a lot of capital raising in the financial services sector, which I term more as confidence capital. It's not capital for growth. It's capital to bolster yourself for what potentially could be further headwinds which could come. And that again is completely dependent on what government does in terms of economic stimuli. What is the extent to which this medical crisis continues to damage the economy because of lockdowns or whatever other actions that the government have to take. And then finally, how long will this last before which we can start seeing normalcy return? And it's a completely new normal. Ashok talked about it, and I won't get into that. But basically, to make sure, how do we get that? So I do believe that most investors have already looked at what they have in the portfolio, taken the necessary measures over the last 30 to 50 days. We've been like literally all of April, I've only spent doing that. But as we go forward and roll forward in the next few months, we just sent a letter from the IVCA to the Indian government. And at last count, we have something like $80 billion of dry powder, which is focused on India. Global funds, regional funds, Indian funds all put together. So there is a fair amount of capital which is available. Obviously, since valuations have come down, it's going to be really, making sure that, ace bankers like Ashok can put deals together and get buyers and sellers to agree on valuation. But I think there is an opportunity in this crisis.
Yeah, absolutely. And on that note, maybe I'd like to highlight one statistic. I was reading somewhere yesterday that today, the 50% of the top 500 Forbes companies were actually founded in one crisis or the other. So very interesting, small statistic, but interesting to note. A lot of great companies would hopefully be built in this year or next year worldwide. So Ashok, I think we have somebody who just talked about deals that you can present to him right now. But in your conversation also said there are businesses that you run which are capital-led and there are businesses which are agency-led. And you did talk about the fact that the next 6 to 12 months might be good for the agency businesses. Whereas when I heard Manian, at least he was not so optimistic, at least in the short term, on the agency businesses. So one, I would like to get a little more from you. Why do you think this would be positive? And the second, has your view fundamentally changed in terms of how you want to invest in them for the future? Or how are you thinking of growth opportunities in those businesses? Or you think both have their fair share and eventually a diversified business model is better than running one versus the other?
So really 3 questions, Nitin. Is there really an M&A and investment banking opportunity in the short term? B, is there a change, or are we perceiving a change, or will there be a change needed to build some of these businesses from the way we have built it in the past? And C, is there going to be a focus on one versus the other? Let me start with the first one, which is the investment banking opportunity. It's my belief that government stimulus, and government is in the process of announcing that stimulus, will create a near-term opportunity in certain segments. We are told that there is going to be a huge amount of focus, we still have to hear it, on infra, for example, and let me use infrastructure as a good example. Government recognizes that the biggest threat to our country, whether it is the social fabric of the country or the economic order of the country, is really going to come from employment and unemployment. We know that current unemployment figures have reached dizzy heights of 27% and moving upwards in India. We also know that 40% of our GDP is contributed through the consumption cycle, the consumption engine, as I call it. And the two are automatically and naturally linked. Higher unemployment is a destruction for consumption. And obviously, as you create more employment, we're already moving up the consumption cycle. Every government at this point of time is looking inwards and saying, what do I need to do to ensure COVID-19 is here? The medical challenges of COVID-19 are here to stay with us. That we have to create additional hospital beds, that we have to create a vaccine, that we have to administer the vaccine are all here. But we can't wait for things to happen sequentially. We have to make things happen parallelly if we want any chance to be able to even revive this economy in a W shape. The threat is not, the challenge is not between V and W. My own view is that until we have a long-term solution for COVID-19, for coronavirus, it ain't going to be a V-shaped recovery. It's more likely to be a W-shaped recovery. There'll be a recovery and then there'll be a challenge and then there'll be a recovery again. But the concern that the government has is not V versus W. The concern that the government has is V versus L. The threat that this increasing unemployment and the threat that this reducing consumption is doing is whether we're going to go into an L mode of recovery. And that's what every government wants to avoid, which is why, according to me, infrastructure is going to play such a critical role. Now, whether I want to define infrastructure in a broader sense, don't just take it as roads and highways and railways and ports. I would also include real estate related assets in that category. And if government is going to support that, pump that, I personally believe there is a very large opportunity, because we also know that infra companies are over leveraged. We know several of them who not necessarily taken good care of their balance sheet, and they will need more capital. Either they will need more capital, or in a stressed form, they will need an acquirer. So I genuinely believe, using infra as an example, that as government pumps in more money with the larger objective of trying to A, improve employment, and B, improve consumption, it will have to pump in more money. It will have to accept more money coming from overseas, whether it is in telecom towers, whether it is in fiber, whether it is, as I said, in ports, power, in every such aspect. So using infra as an example, I would say there is a natural opportunity. Dhanpal alluded on capital raising will be critical for BFSI companies to not just grow, but survive. It doesn't matter what the pricing. We know that the pricing has really moved significantly downwards. It doesn't matter. As a very eminent reserve banker told me, banks and financial institutions have no choice. Their choice is between raising capital at any price and surviving. So I don't think people are going to worry about what my price is. People are going to shore up capital. That's going to give opportunity, as I said, to either acquisitions or, of course, new capital raising. So I would argue and say that certain segments for sure are going to provide an opportunity even in the near term. Of course, we have to wait to see what the full destruction is, and God willing, the destruction will be nominal and not significant. But if the destruction is even more than nominal, I think there'll be, in the medium to long term, many more opportunities. Let's go to the second issue of what's going to change, even in the businesses that we do. I think one thing for sure, we are all going to operate more from home than from offices. We have all learned that the most efficient use of our time, and in the agency business, time is the most invaluable commodity that you have. We've all learned that working from home is a significantly more effective and efficient way of operating. And therefore, we all have to embrace technology. I don't think we're going to go back to traveling like maniacs the way we used to. I don't think we're going to go traveling from one corner of the city to the other corner of the city, stuck in the traffic for 45 minutes and perpetually running late for meetings. I think we're going to be at the press of the button, and we're all going to use technology. Digitization. Do we even have an option? There was a threat that fintech was giving to all, physically run businesses. I don't think fintech is an option anymore, Nitin. It's digitization. We can see, who's the winner in the entertainment industry. It's not that entertainment is not going to get consumed, but you're not going to go to the theater in a hurry. It's all going to be OTT. So you can see how technology is providing you exactly the same experience in the convenience of your home, and of course, in the protection and hygiene of your home. So I would argue and say that the way in which we do businesses are going to change dramatically. Now, it may not change dramatically in every business. In the investment banking business, there will still be meetings where we will have to sit in those 3 rooms one for the common room, one for the buyer, and one for the seller. And we'll have to keep going between those 3 rooms from time to time. But that will only happen when you're coming to the close of a meeting, not otherwise. And the last issue, as you said, are there some businesses where there's going to be greater focus than other businesses? And I would argue we will all go back to what we learned as the first lesson from McKinsey. Go back to doing what you do best. And I'm not saying that we are going to desert businesses which are not core to us. We are continuing to do all, we will continue to do all businesses. But really the focus will be to go back to doing what we do best. So for Ambit, for example, lending business is important, will always remain critical. But you know, what we really do well is the agency business. Lending business is built because you gain scale and you get consistency in your flows. We all know that agency business is lumpy. So you're not going to desert one, but you're going to go back to focusing on your core and saying, how do I build the business that I do best in these environments?
Fantastic. Dhanpal, I'll come to you. And this is a favorite topic for me. I think Ashok and Manian both alluded to it, that I mean, every promoter, every company that I'm talking to now is looking in some form or the other to raise capital. We have already seen a set of very large companies coming and hitting the market with capital raise. And in the next few, I think quite a few are lining up. So this is like, it would be like a buffet, if I can say, or you'd be really spoiled for choices as an investor if you have dry powder, which I think as an investor currently you're sitting on quite a amount. So how are you thinking of capital allocation right now? So there are 2 parts to that question. One, when I talk to some of the PE guys, some of them are saying that we are very focused on our current portfolio companies. And currently, at least, they're not looking at opportunities outside of the ones that they are already invested in, trying to support their existing companies. The second theme that I've started to hear, which is slightly strange for me, but I'm hearing this from quite a few PE guys now, that they become more open to even looking at some public market companies, because the valuations in the public market space might have corrected a bit more than what we are seeing in the private markets, because maybe there's a lag in terms of price expectation on that side. How are you thinking about capital allocation right now?
Yes, Nitin, you're absolutely right. I think the first thing is to take stock of what you have on hand. And I think it's absolutely a very valid thesis to have every PE firm, what you said, is first doing basically is checking internally that how is the portfolio doing and what needs to be done to support that portfolio. Because, you know, these are your assets. You have to make sure that you protect and preserve value. And then basically as markets normalize, you then focus on growth. Having said that also, I think the other danger that we are seeing is what I call the danger of something called strategy shift, okay, or strategy drift is more appropriate. The big challenge with investment managers is essentially that through cycles and through markets, you have to be very clear about what you're doing and why you're doing something. So for example, we are very clearly control investors where we build businesses from scratch through platform businesses, or we buy businesses and we grow them, right? And therefore we're very clear that that is all that we will do. Now, the problem with any such decision when you build or buy, obviously one is the purchasing cost, that are you buying something at a price you think is sensible? And 2 is clearly, is there a clear, visibly defined market opportunity, which you can in some ways try and estimate through a reasonable 12 to 36 month period. The problem today is that there's absolutely no visibility what's going to happen even in the next quarter, let alone what's going to happen in the next 12 months. Okay, you're only right now looking at market signals. You're looking at what government is doing, and you're trying to basically stay afloat, right? So it's going to be, in my view, a fairly choppy water. And in some cases, I would even say quite adventurous for people to go out and start putting capital to work straight away. Having said that, I think there are businesses and franchises which are very high quality, where clearly valuations have adjusted, but who will raise capital. And those are the ones I think will be the ones who will be first off the block to actually get capital and get money in there. So I do believe that as a PE investor, our business is really of drilling lots and lots of dry holes. And then we may strike oil in some of these holes, but it's a business that we are not, I would say it's not alien to us. It's a process which is not alien to us, and we will continue to do it. And like I said, history has taught us that there is a potential coming out of this crisis to make extraordinary returns. And therefore, the effort that you will see investors make in this time is going to be far greater than even under normal circumstances.
Just as a follow through, Dhanpal, I know that you also end up interacting with a lot of global allocators, people who take a lot of decisions in terms of capital flows to India. One, I would like to just generally know how the mood is there. But second, I think I've been talking to some of the important policy makers and people who influence policy at different forums. I keep on hearing this talk that fiscal prudence is an important vector, and of course it is. But the government and generally some of these regulators have been very concerned about the rating. And one of the talks that I hear in those conversations is that global allocators and flows into India would be very severely affected if for some reason the rating of India was downgraded. I have a slightly different view on that, but that for later. But I just wanted your take on the same, because you anyways interact with them. Do you think, are we being overcautious, or you think that's actually quite right way to approach this and the right way to think about the market?
So I'll maybe address this more from a private capital perspective, the world of alternatives, as looking at public markets and index funds and those kind of things, because that has a very different, more short-term kind of, I would say, orientation. If you look at it, and that also, ratings is very important when you're basically allocating through index funds, because your rating is immediately you will see flows in or out depending on the rating. But if you look at the world of alternative capital, one, very clearly, like I said, the world is seeking more returns, and therefore there is a very clear directional shift to move money from passive capital to alternative capital. And that trend, I believe, will continue to only accelerate. In the world of alternative capital, I think, like I talked about the larger emerging markets, but India has been now getting increasing share, either through global funds participating or through regional funds, or even, I would say, the more established country funds are basically now putting money to work. It is a fact that today everything has gone into freeze, right? Whoever was looking to allocate capital is right now basically stepping back and looking at their own portfolio, because there's clearly been value destruction globally. And to that extent, for the next 3 to 6 months, I believe the only programs which will continue is programs that they've already identified shortlisted people they want to back, and they might even pull back from some of those, and or they might basically continue with those programs. There is no new program that will get initiated right away. They will use the next 3 to 6 months to figure out, and I think the real programs will only start coming in towards the end of this year, as there's more visibility on what's likely to be in 2021. And then you'll start seeing a fresh dose of capital being allocated. Having said that, the last 2 years has been possibly record years for the global fund industry, where PE funds and infrastructure funds have raised record fundraisings. $50 billion funds, $80 billion funds, people like SoftBank obviously have even raised great amounts of capital. So I do think that in the short term, one should expect that there will be a pause. But as we come out, I would say towards the end of this year, you will start seeing an interest build again. And India has to do all the right things for that. Now, on the rating front, when you talk about, I think there's a clear issue. We can't get away from the fact that if India slips for whatever reason below investment grade rating, we will be severely hampered as a country which is looking to access global capital. Whether we like it or not, most global programs have a very clear demarcation of investment grade and sub-investment grade. And the moment you are sub-investment grade, the pool of capital available to that country shrinks dramatically. So we have to be extremely careful about it. But what I also understand is rating agencies are not necessarily focused on the immediate crisis, but also focused on seeing how the country will come out, manage itself in this crisis, and come out and can show directionally the growth over the next 3 to 5 years. India has a very strong local demographic. We've clearly seen demand and supply destruction. What the government does, I think, in the next few months is going to set the tone where the rating agencies will continue to support us with a rating which will be there. Hopefully, Moody's is, I think, one notch above S&P, but both are clearly at investment grade. And that is what I'm believing, that all what you're seeing the government do now is keeping one eye on making sure that there is, I'm presuming, backroom or backdoor, chats happening to make sure everyone is comfortable with the actions being taken. So I do believe that, if you think about it, right, the way the developed markets are printing money, if they were an emerging market, their ratings would have been completely shot to smithereens. But because they have high per capita income, they have high wealth, and they obviously developed economies, they get away with what I would call plain murder.
Very interesting.
Manian, I would love to hear your views on this.
Yeah, Manian, sorry to have kept you waiting for so long.
No, sure.
Yeah, you should add to this, but I also wanted to ask you one or two more specific questions. Well, I think we did touch upon agency, we did touch about investors, but I think even before COVID, Manian, if I'm not mistaken, I think there was a serious amount of risk aversion that had crept in the entire lending system, right? Whether it was banks, whether it was NBFCs, and I think the credit growth was abysmal. And I think after this, the crisis, I think it has just worsened and has gone to a level where banks are putting 7 lakh crores overnight in reverse repo, and RBI is trying to give it back to them. Is there something that can be done to break this logjam? Yeah. So you can actually address, you can extend what Dhanpal was saying, and maybe then you can answer this whichever way you create.
Yeah, Dhanpal, again, I agree with most of what you said, though I also believe that finally this rating business is also, we have to be, at least my personal belief is we can be a bit bolder, because finally it is a matter of relative positioning of countries, right? So, and this impact of COVID is, the good part this time is almost every part of the world is impacted. So everybody's fiscals are relatively speaking weakening, right? So therefore, how relatively we'll weaken vis-a-vis the others will probably influence the rating downgrade part of it. So I personally don't think, and if you see, while of course, the positioning is that it is a 10% fiscal program, all of us know that significant proportion of that is a liquidity oriented program, and a small part of it actually hits the fisc immediately, right? So I think, while it may look like 10%, I don't think we are hitting the fisc with 10%. So I think just now I wouldn't be that concerned about the, of course you have to keep an eye and you have to make sure that India does not get derated. But I think the risk in my mind is relatively low in the current environment. Now coming back to what Nitin raised, you are right, because even before COVID hit, it has been almost a 2 year of slow, at least if not 2, maybe 1.5 years of slow growth, relatively slow growth in lending business. That has been the situation. So I think COVID has come on top of an already slowing down economy or already slowing down scenario on the lending side of the business. And RBI can only do that much. RBI can create liquidity. Yeah, it can give money in the hands of the financial system, but to make them take the risk is different from just providing them liquidity, right? And the banks cannot just take the risk because they have the liquidity, because lending business, as we often say, is a 100:2 business. If you lend, you risk 100 rupees, and if you make a wrong decision, you lose 100 rupees, and if you make a right decision, you make 2 rupees. Right? You make 2 rupees spread on it. So it's a 1:50 odds bet. So lenders, that's the reason lenders are that conservative. And you add this to the high leverage that banks carry, the risk is even more. So what you lose is almost entirely, you may lose 2 rupees on 100, but you have lost 2 rupees out of 10 rupees of capital or 12 rupees of capital you employ. So I think lending business has to be a conservative business. It cannot be an adventurous business. Since you talked about the slowing down economy and COVID impact is not just about slowing down, right? At the end of COVID impact, I think there will be several business models which will be destroyed or will be reset to a different level, right? So today, if there is a lender, it's not about, like you mentioned in the case of Dhanpal, there is a buffet available. Technically, there is a buffet available to lenders, right? I mean, today, if we want to grow the balance sheet, it's damn easy, right? Because there is constrained capacity. There are large part of financial sector which will struggle. So it will not be growth oriented. So if you have a good balance sheet, you can go and select customers and go and do it. But it is not the same today as it was even 3 months back, because there'll be business models which would have been destroyed. You have to think about, nobody can take for granted that a company will survive at the end of it. And therefore you have to be very clear who comes out of this and in what shape. So, high leverage, high operating costs, these are completely something that you have to be on top of. Dhanpal also mentioned some of this, right? So when we are lending today, we are very, very conscious as to, we can't take any of them for granted. Whatever the name will survive. Yeah, one. Two, if they are companies with high leverage, high operating cost, we have to really drill down to much greater extent than we have ever done in the past to convince ourselves that we are making the right bet. And, like I said, at the end of this, there is great reward for being the last man standing. And we cannot let that opportunity go. So yes, there is an opportunity to lend, but I don't think you should rush into lending. This is not the time for being adventurous. I would say that you generally conserve capital. Do, of course, use your balance sheet judiciously to clients who otherwise you wouldn't have got in better times. And this is the opportunity for banks who have the capability to do that now. So I think using balance sheet judiciously at this point in time will differentiate you from any other bank. And that's what it has to be. It has to be conservatism at its, whether you call it risk off, I don't like to call it risk off, but the fact is conservatism is a must. I mean, whether it is called risk off or not is a different issue, but conservatism is absolute essential at this point in time. I would bide my time. If I have a good balance sheet, I would bide my time through next 6-12 months, because I know that at the end of the 6 to 12 months, there'll be a huge opportunity.
Yeah. So, Manian, I think very well said as a banker. But what I'm trying to also understand, it might be exceptionally prudent from, let's say, a particular bank's point of view to be extremely conservative. I think it is actually becoming quite troublesome because of lack of credit in the system. Is there something that RBI, is there something that government can do, should do to open up the economy? Because I completely understand, given the situation, no banker wants to take the risk and they should not, because you explain the risk reward. But then again, if the economy has to restart, somebody will have to open the purses, right? So how do you solve for that?
I think, Nitin, the step on MSME that the government has taken, the 20%, is the right way to go. That's the right direction, right? So that significantly enhances the risk appetite of banks on the MSME sector, because it is not only about the 20, right? It is also about the 100 which gets protected better. So, in India, for good or bad reasons, but historically, the role of liquidity is RBI's, and role of giving risk protection to the sector has been taken on by the government. And I think that's how it has operated, for good reasons or bad reasons. As long as the two work in tandem and work in coordination, I think it's good enough. It is not necessary, because there are other countries where central banks have expanded balance sheet and taken on commercial assets on the central bank balance sheets. India has tended not to do that, right? Or I think they did it at one point in time and the experience wasn't great. So it has tended to follow that the government should take care of the risk part and the RBI will take care of the liquidity part. And initially, for the last about 40 days till the last 5 days, I was feeling that it was a one horse pulling the cart. The RBI was pumping liquidity, but it wasn't helping the banks in taking the risk. But I think the last 5 days, I have changed my mind a bit. It's a new development, definitely. I mean, you should change your mind if a new development happens. I think clearly the fact that they have come back and said that 20% risk protection, 20 is a reasonable number as well. It's not a very small number, right? So it's the right way to go. what they have done about NBFC paper by giving it guarantee, I think is the right way to go. So I think somehow this it is becoming a two-horse pulled cart. I think it is the right way to go. So all I can say is that. The second, of course, is to see, one is the financial sector part of it. The second is, this exit strategy from lockdown is extremely important. The execution, government's execution on that will be very critical. Of course, people called it VW. I actually call it the shallow U recovery. It will be a slow recovery. But I think what will be critical is how we exit out of this, whether this exit happens. I mean, you may, like somebody said, it may not get to 100%, but will you get to 90% of the earlier level in 3 months, 6 months, or is it going to take 9 months, 12 months? Is going to be critical, because finally, the financial sector is not separated from in its performance from the real sector, right? Unless the real sector is fixed, you cannot keep fixing the financial sector for all the ills of the real sector. So real sector has to come back, right? So I think that is going to be the key measure. I think they have taken some of these measures now, which are good for the time being. Of course, like I said, if the real sector takes longer to recover, more may be required, even to support the financial sector. But I think the three have to play in tandem: RBI, government promoting risk, RBI promoting liquidity, and the government promoting the real sector. Unless all this triad falls in place, I don't think there is a final, deliverance from this.
Excellent. Thank you. Thank you, Manian. I know that we are slightly short of time. I will go on a very quick fire 2 questions now. Maybe Ashok, I'll start with you guys, and then all of us can have a shot at that. One quick big theme that you think will benefit disproportionately coming out of COVID, an area where you think a lot of money can be made. Ashok.
Sorry, can you repeat the question? My apologies, I didn't hear it clearly.
No problem. Ashok, what I was saying is one theme that you think will disproportionately benefit coming out of the COVID crisis, an area where you think a lot of money will be made.
Now, hold your horses, strengthen your balance sheet, and wait for the big opportunity to acquire something.
Interesting. But any sector, any particular area which you think will benefit, other than, what you're talking about is how to approach it. But let's say a lot of people are talking about technology companies doing better and all. Any such sector? No.
I mean, in one sense, opportunities will come across every single segment. But if you think about sectorally, you have to assume that America will come out of this the first. And therefore, you have to say, what is it that America will consume the most? And that's technology. So the America-India corridor, the US-India corridor is perhaps the biggest beneficiary. Somebody else will say that, there will be dislocation of production in China. And therefore, whatever you can take from China to India, and I would focus on the chemicals and the intermediary section, I would say those would be two big, one on the manufacturing side and one on the services side.
Understood. Dhanpal, your take on that?
Well, I think climate change is going to be a massive beneficiary. We are all, clearly living in an environment which has been very difficult. I think both from an oil security as well as from a reduction of carbon within the atmosphere, I think India has got a big role to play here. So I believe this will just accelerate everything on that front. And second is the digitization acceleration theme, right? And I think in some ways, I'm already seeing that every business we're thinking about will have to think itself as a health business. Ashok alluded to it, but if we think of our restaurant business, if we think of our retail business, if we think of all our businesses which touch consumers, everyone's going to think about it, as to how we do it in a manner which is safe, which protects the consumer, which basically is healthy, etc., etc. So you're going to see massive change in consumer behavior. And I think that's going to drive a lot of trends, which will drive a lot of interesting opportunities.
Sure. And Manian, anything from you?
My 2 or 3 big takes is, I think at the end of this, in the financial sector, the non-risk revenues, which is the, franchise agency kind of revenues, the relative importance of them, those will go up in the financial sector, because people will realize that those are less impacted than the risk-based, lending-based revenue. I think, I often find it that even when many even investors, very learned investors, do not make that much difference. If they look at our PBT or PAT, they do not differentiate the value of non-risk revenue in it and risk revenue. Sometimes I feel that the value of non-risk revenue is almost 6 times the size. I have a math on it, but that is for some other time. 6 times as valuable as the lending revenue. Yeah. So,
yes.
So that is, I think that will be more clearly felt as we go forward in this, and therefore the value of those businesses will be felt more. Second, I think appreciation of risk and unknown risks are usually never priced in the market. And I think with this, I am hoping that the market will learn to price these risks better. And I think that's a great opportunity. Third, Dhanpal said, I fully agree with him. I think digital has got a new momentum by this. Customers are dramatically moving. Some of them are being pushed into it, but we are seeing dramatic move towards digital in our customer behavior. And I think it has just step changed the trajectory. It was as it is going on, but I think it has step changed the trajectory. And an interesting thing is, I think one of the biggest casualties of this thing is trust. Tomorrow, I think the trust in human dealings from the health point of view is a new angle that has got introduced, right? Tomorrow, people are going to worry about shaking hands. They are going to worry about having meetings in one room together, because you don't know who's exposed how much. And I think to bring back that trust is going to be an interesting process. Or of course, if a vaccine comes and, again, people think vaccine comes and it comes and quickly. Vaccine programs, inoculation, India has struggled to, even now you see polio inoculation ads on TV 25 years after polio vaccine was discovered, right? So people assume that vaccine comes and tomorrow everything is solved. It doesn't happen that way. I think so. This health impact of this on human behavior in this case, I think is going to linger on for a while. I think that is going to be an interesting change.
Excellent. My last question to the panelists, and otherwise, if I don't ask this, I think it will be injustice to Indusion. It has to do more with HR. I think we have seen tremendous shift in employee behavior and how we are conducting ourselves today. Do you think this is permanent, or a lot of permanency will seed in terms of how the workplace in the future will look like, or will it most likely come back close to normalcy, maybe 6-9 months out? Or I mean, I hear TCS saying 75% of our workforce will be working from home 3 years out. Is this real, or is this a lot of immediate reaction to what has happened? Your take, and you guys can go in whichever order you prefer.
I would say that, yeah, of course, its usual tendency, as in the good old saying is mandi mein mandi or teji mein teji, right? So of course the opinion will dramatically shift. The reality will lie somewhere in the middle. Many companies have been trying to do work from home, haven't succeeded. Now they have found a way to succeed in it. So obviously work from home will go up. Obviously digital will go up. Obviously workspaces, like I told you about this trust factor, the workspaces will have to create that trust even amongst employees, right? And therefore workspaces will look different for a while. So I think some of these changes are there to stay. The magnitude of the shift of that pendulum may not be as much as people are talking about now, but will it shift? Positively it will shift. It will also mean that, like I said, the employees have to also worry about if this lingers on for 12, 18. I was concerned that Dhanpal at a point in time was saying 36 months. If it goes to that 36 months, let me assure you that job losses are certain. Everybody will look for efficiencies. Job losses are certain at that kind of extended time frame. So I think people have to think about reskilling. They have to think about finding relevance, their relevance. Some jobs may lose relevance in the new paradigm. For example, if a video KYC happens, I am sure sales force of many financial sector companies will reduce in size, right? It is a natural outcome of that, because a lot of efficiency will come in on video KYC, correct? So some of the jobs will lose relevance, and I think people will have to reskill themselves to find relevance back. So there will be some challenges, I'm sure, but each person has to be alert to it and act on it. And I'm sure many will. You have to think of skills outside the industry that you are in, maybe sometimes.
Dhanpal, Ashok.
Yeah, just to add from Manian's perspective, the whole idea of a customer journey, right? If you think in financial services, the cost of acquisition and the cost of operations related to that customer is absolutely critical. And if you look at the human intervention which is required in that entire journey has been very significant, right? Pretty much every sector, whether it's an agency business or a balance sheet business or whatever. And I think this acceleration of digitization of the virtual economy, which is going to take place, because so far it was the, I would say, economy of the millennials. But now, because everyone is sitting at home, like Ashok said, even I, right, have learned how to use technology to the benefit of the organization, which we were not really, right? We were so used to having our secretaries, we were so used to having people around us, someone getting coffee, doing this, doing that. If you really think about the extra, manpower which went in managing a live workplace as compared to a virtual workplace, there is no doubt in my mind that there is going to be a transition where you will see organizations morph around this and use digital to basically help. So that means it's like any technology initiative, you are going to see job losses in the near term, but hopefully that should lead to also 20 new business opportunities. There are lots of startups which are talking about coming and doing various things in this new virtual economy. And that should hopefully lead to more, like every business is talking delivery now. Delivery was only a very small part of this economy earlier. Today, every business literally is figuring out a delivery mode. And that itself will lead to a very different business model for everyone. So I do feel, that jobs has been a bigger problem for India, but we've never been able to solve it through the organized sector. I think there'll be a lot of entrepreneurial, startup class, self-employed people who will figure out how to use technology to make themselves more efficient and more productive.
I personally think that one of the most important focuses, even from a people perspective, is going to be health and hygiene. I think, we are all going to be so paranoid. And of course, it depends on whether, as Manian rightly pointed out, this goes on for 6 months or 18 months or 36 months. They say human memory moves on quite fast. And therefore, if the impact is short term, I think we will relive a new life soon. If the impact is long term, it's going to take us a long time to revive and come back out of that challenging environment that we are all facing at this time. So I would say there's going to be a lot of focus in every office around hygiene and healthcare. How are we eating? Where is the food coming from? What sort of food are we eating? We're all going to change the vendors that supply our food. We're all going to change the manner in which that food is served. Today, we take great pride in saying this food is made in my cafeteria. That will go away. It'll all be packaged food coming from secure healthcare place where you are comfortable because it is corona free. It is it is healthy and safe. I would believe that in the short term, if nothing else, to protect our respective businesses, we will all be looking very hard at costs. And when you start looking hard at costs, you suddenly realize, but here are 10 people that in the last 45 days I didn't need to talk to. While you're sitting in the office, those 10 people were very relevant because you saw them in the elevator or you saw them in the foyer when you came in or you left. So there was a lingering memory of those. Today, you haven't spoken to those 10 people in the last 45 days. And the question you're asking yourself as a business leader is, do we really need those 10 people? So it's not, there is obviously need for compassion and we are all going to be very compassionate about it. But the significance of whether those people are needed or not needed is not lost to the human mind. And at the first opportunity, as business starts growing, and as we see newer opportunities, and as the compassion angle takes back seat, and the meritocracy angle takes the front seat, which will happen to all of us, you will actually see, changing that pattern, removing those people. And as Manian rightly said, we will have to find ways of reskilling those people. We'll have to find ways of reutilizing those people. in some other form and shape. Businesses are going to change. Let's go back to a famous example. I mean, a year ago, before ILFS happened, the most famous business in the NBFC portfolio used to be structured lending. Where is structured lending? It's gone. Nobody wants to talk about structured lending. Everybody wants to hide their structured lending book under the table. Why? Because no lender wants to give you money for structured lending, and no investor wants to give you any premium. There's a discount to the book for every structured lending book right now in the market. Will it remain that way? Perhaps not. As distress sets in, as more and more good quality promoters running good businesses realize that there is less capital available, the product will come back. So I'm saying there's going to be huge amount of intellectual challenge and intellectual rethinking. What is important is that human beings have always found productive, successful solutions to tackle these problems. Whether it is the guy who's getting unemployed and therefore needs reskilling, or whether it is the employer, the compassionate employer who says, I have to find a new occasion to reutilize and reuse either my people or businesses. A lot of that is going to happen. So I think I would say this in summary, that the next 12 months, 18 months post-COVID are going to be very interesting months. They're going to be challenging at one level. They're going to be very interesting at the other level. They're going to challenge our mental bandwidth. But I would also think they're going to create a very interesting collaborative environment. Peers will no longer be just competing. We'll be collaborating with each other to say, how are you tackling this? Because nobody is going to be able to tackle all these problems alone. And therefore, collaborative nature in peers is going to become the new order of the day. I'm going to go to Manian and say, how are you handling this? And he's going to come to Dhanpal and say, how are you handling this? And then one day, three of us, of course, in a virtual manner or with a mask on our face. By the way, don't forget, that's the permanent feature of our personality going forward. Yeah. I've already seen shirts coming out with
shirts that's right.
When we talk about transformation, we are going to have to use masks wherever we go, regardless of whether it's a year from now or 3 years from now. And the question I was asking somebody, since I'm watching this famous program called Money Heist, is it going to result in new money heist because you can't identify the face of the new person under the mask? So wonderful times ahead, ladies and gentlemen.
No, and I think the important part is going to be organizations and their HR professionals will have to figure out how the change in skills, how are they going to manage the workforce? Obviously, like Ashok said, we have to show compassion. We can't just be, saying we don't need this workforce. I think they'll have to change their mindsets into retraining, reskilling, and these will be the bigger challenges for the HR departments and organizations. I think it's going to be interesting times.
Nitin, you're on mute.
Nitin, you are on mute.
Sorry. Guys, thank you so much. With this, I would like to hand over to Vijay because I know I'm really short on time now. If you want to take some Q&A or the way you would like to take this forward, Vijay.
Thanks, Nitin, and thank you, everyone. Now, obviously, I know we are overshot on time right now. So what we'll do is, if that's fine with everyone, we'll probably take a couple of questions, and that's how I think we'll end about the current the event. A quick one, if I may just shoot the first question, which is to Ashok. And the question is, Ashok, as a founder promoter, what will be your final guiding words for those in the audience? And many of them could be young, established entrepreneurs who will be keen to understand what grounds of caution and measures to be taken to safeguard both business and employment.
I think my first and opening remark to you, all of you youngsters, is going to be remain positive. These are times when there is enough happening around us to create negative energy. Unless you learn how you overcome these negative factors, you're never going to be in a solution-oriented mood. We all have to understand that we have to be in a solution-oriented mood. So when lockdown began, my first commitment to myself was, I'm going to live life exactly the way I lived when I was in office. I converted a little room in my house into an office. I get in here at 9:30 in the morning. I take my lunch break at 1:30. I come back at 2:30 and I'm here up to 7:30. So don't lose focus and remain positive would be my first thing. The second would be, we have seen over and over and over again, and we've seen this particularly in Indian context, leverage to grow for the sake of growth, leverage to grow purely because you're competing with some peer, leverage to grow because there is greed setting in, has resulted in destruction of some invaluable companies. And if there is one time that we need to rethink, it's now. We think black swan events don't happen. I was actually very fortunate. I've had 3 meetings with Nassim Taleb, the writer of the book called Black Swan. And the last one was at the Jaipur Literary Fest earlier in this year in January. And I kept asking him, I said, I come every year, you talk to me and you say there's a black swan event. I don't believe that there's a black swan happening in my lifetime. Well, how wrong I was. It will happen. So I think conservatism, maintaining balance sheet, and maintaining cash flows. That whole concept of I'll keep burning cash. Well, it was true at some point of time when easy capital was available. Those days are gone. You have to go back to the basics. Strong cash flows, prudent P&L, profitable business, and strong balance sheet.
Thanks. Thank you, Ashok. The final question, we have got some 58 questions, but we'll obviously, we're just picking up 2 given that we have lack of time. So the second question is to you, Nitin. You mentioned about Spanish flu crisis. So the question is that during Spanish flu crisis, the world was not as leveraged as the way we are, especially the Western economies. How much this pandemic can change or will bring differences in the world order and more so to India?
Sure. I think when I used Spanish flu as an example, it is just that. It's just an example. I think every crisis and every time frame has a very different context. So I don't think the way the markets will behave and the way the economy is going to come back will necessarily be similar to how it probably happened in the event of Spanish flu. It was just a reference point to demonstrate that the negativity that might have been there in that period was proven to be incorrect once the event passed out. And I think that is what, in some different words, Ashok was also pointing out, that it's important to be positive and look at the opportunities beyond the immediate short-term impact. Just coming back to leverage, I think what has happened, I think some of these big crises not only affect us, but I think they also affect the psyche of the countries, the regulators. So if you ask me, I think US is very affected by the Great Depression. So when I hear about their talk, even in 2008, 2009, the fact that they were able to print so much money and the kind of decisions that they took, the simple defining objective for them was, we will never allow 1929 to happen ever to US, because they realized that in 1929, they were very, very conservative on liquidity. And they knew that that mistake costed them a lot. So their natural reaction is actually becoming more and more liberal on the liquidity measures. Whereas I think some of the other countries like Germany, for example, is affected more by 1945. So they actually not even 1945, maybe 1920s, early 1920s, when they had a period of hyperinflation. So though they go very conservative. And India in that context is very affected by 2013. If you remember what happened to us, our currency got really hurt. CPI was 14-15%. So our policymakers are very affected by our experience in that period, and we are being far more conservative in printing money, in taking fiscal measures. But one thing stays common, that the regulators, including the government, RBI, and everybody, is far more responsive than what people were in the earlier generations to the crisis. And that's what I feel will happen. Every country will find a different path, but eventually through ups and downs, hopefully we will all find our way to recovery. I feel a lot more optimistic about India because not only, as the audience rightly said, that not only are we not as levered, we have a lot of demographics going in our favor. I think this entire US-China trade war and the anti-China movement does create an opportunity for a country like India. So I think if we keep our focus on the opportunities that will be created in India, I feel very positive about it.
Thanks, Nitin. As I said, we have too many questions, but we're not able to put that today given the time constraint, and we already have a shot. So with that note, just a small thing which we'd like to, also tell all the panelists and all our viewers, given that we all in a state of shock, and I guess there is a lot we all mentally, psychologically going through personally and professionally. What Indusion is also doing as an initiative on a pro bono basis is to offer a lot of career counseling to professionals across the spectrum of a practice which we have leadership into. The idea is very simple that there are queries, there is a stress level about compensation. We spoke about job scenario changing. We spoke about how competencies are going to be looked at in a different way. So I think what we're doing is all our practice leads are available to all of you to answer your questions, to counsel you, to ensure your professional well-being. You just need to write to us at connect@indusion.in. And obviously, needless to mention that these discussions remain very confidential and it's on a one-on-one basis. And please feel free to avail the same. With that note, thank you so much to all our viewers, our panelists, for an overwhelming response, which I can see on the screen. And have a great weekend. And in fact, every day is like a weekend these days. But still, given the Friday and given we have a precedence of
every day is like a working day.
Working day now.
There is no Sunday.
Much more harder than what we normally do. So with that note, have a great weekend, everyone, and please take good care of yourself, and we stay connected. Thank you.
Thank you, Vijay. Thank you, Nitin.
Thank you very much.
See you, Ashok, Manian. Bye-bye.
See you, Ashok. See you, Dhanpal. Nitin, bye.
Bye. Bye. Thanks.